Good evening, everyone. It is my pleasure to welcome you all to a call on update on Edelweiss Business Cycle Fund. As you are all aware, that Edelweiss Business Cycle Fund was a very unique offering from our basket of equity funds, which is managed by the Factor Investment team. This fund was launched in the month of July, and we have completed more than 3 months. In the meantime, we have seen a lot of volatility in the market having touched a peak of 26,000 plus and now hovering between 23,000 to 24,000 on the Nifty. Similar correction have been witnessed in various other indices, and more importantly, NSE 500, which is the benchmark for this product. We thought that this is an appropriate time for you to give, for us to give an update on the performance, on some portfolio changes, and what to expect from a product like this going forward. To throw some light on the product in detail, we have with us the co-head of Factor Investment team, Bhavesh Jain. Bhavesh is also supported by his co-head, Bharat Lahoti, who will chip in wherever required. So, Bhavesh, welcome to this call.
Hi, Deepak. Good evening, everyone.
So, Bhavesh, let's start with the first question. The premise of this product was that over 3 to 5 years, we'll be able to do effective sector rotation, stock rotation, and hence would be able to generate meaningful alpha for the customers. Now, the time period is very short, but what we have seen is quite the opposite, where in last 3 4 months, on a since inception basis, the fund has actually underperformed by 2 3%. So, do you think this is a usual phenomenon, unusual phenomenon? How do you see this in the light of what has happened to the model over last 10 15 years?
Sure. So, just to put things in context, Deepak, if you will see, this is a unique fund where we are using factor-based investing to actually rotate sector and try to capture the business cycle over a long period of time. Now, if from you can say from the time when we have launched, we have seen a lot of volatility in market. Just before the launch, we saw election result and some volatility coming from there. Then July it was budget, August it was yen carry trade, then September it was US inflation data, October, November, it is sustained FI selling along with geopolitical escalation between Russia, Ukraine, Israel, Iran, and so on and so forth. In between, we concluded Haryana state election, we completed US election, and now we are just tomorrow you will get result of Maharashtra and Jharkhand state election. So all this thing had led to a lot of volatility in market and similarly a lot of volatility in performance of factors also. So you will see over last 1 year, value and momentum continues to remain the best performing factor. As you know, we are using combination of value momentum, growth plus momentum, and quality plus momentum while selecting stock in our portfolio. But as the data shows, things have changed drastically in last 3 months. The best performing factor, which was value and momentum, over the last 1 year, you will see in last 3 months, that is the place where we have seen maximum pain. Low volatility, growth, and quality has started outperforming, and value has seen a big reversal. That, if you have to give a fundamental reason, after change in, you can say, government, that is 2024 Lok Sabha election, focus of government now will be because it is no longer a single party majority government. Focus of the government has shifted, and that's why you will see stocks which were having a dream run because of you can say government focus on that particular sector, whether it was defense, whether it was railway, whether it was manufacturing, capital goods. All of them has taken a beating in last 3 to 4 months, and that is partly you can say a reason for underperformance. So whenever this factor shifts happen, so it is like normally whenever you see a one way direction in market, whether it is a bull market or a bear market, and then when you see a pause or a change of direction, you see some of the factors try to change their color, and that is what is happening. We are seeing a gradual shift from value towards quality, and whenever this transition is there, momentum as a factor suffers, and that is what is getting reflected in our portfolio. But as you said, we have done backtesting of this model for last almost 15 years, and this is something which we have seen multiple times. So you, or this is the all the quarterly data where we have underperformed the benchmark. And if you will see in last 12, 13 years, that is from November 2011 till you can say latest period, this is the instance which has happened almost you can say 15 to 17 times where we have underperformed the benchmark in any quarter by anywhere between you can say 1.5% to as high as 8 to 9%. So this is not something which is happening for the first time. It has happened more than 15 times in last almost 13, 14 years. The interesting part is look at our underperformance on a quarterly basis. It is ranging anywhere between one to you can say other than you can say that COVID year where it has gone to you can say 5 and 9%. It has always remained in the range of 2 to 3%. This time also you will see since inception our portfolio is down around 10%, whereas the benchmark is down close to 7%. So we are underperforming the benchmark by 3%, which, if you look at historical context, is like every 1.5 year, we had this kind of situation. But the interesting part is look at the second half of the table. Whenever we have seen a quarter where we have underperformed the benchmark on an average by say close to 3%, in subsequent 12 months, the recovery phase, you will see on an average our outperformance is close to 12%. So we have already seen the painful time of 3 to 4% underperformance. But as I said, any equity product, you have to give a slightly longer horizon. And if you see historically, whenever you have given one more year after such a painful time, that is in fact the best time to look at this fund because the recovery is very sharp. And then you can see in almost all the instance, other than that, you can say 2018 period where it was long-term capital gain tax and then ILFS, DHFL, you can say NPAs and all that stuff. Other than that, we have never seen a period where we have underperformed for a quarter and then for next 1 year again the underperformance continues. Most of the time period we have been able to recover the underperformance and not only recover the underperformance, in fact, almost you can say 10 to 12% outperformance over next 1 year. That has been the history. So this time also if you'll see the way markets have behaved, the way things have happened, it is in line with history. It is in line with our, you can say, back-tested numbers. So there is no worry, or there is no need to worry. There is no need to get panic. This is in line with expectation, and that's why we say that if pain is in line with expectation, then hopefully recovery also will be in line with same what has happened over last many years. So nothing to worry. In fact, if anyone would have participated, this is the time to you can say top up over there, or if someone would have not been able to get opportunity to participate in the NFO, I think for those set of investor, this is you can say a very good time, particularly after a decent correction across market. If someone wants to increase equity exposure, I think this is the best strategy to participate the recovery phase of the market.
So Bhavesh, let's spend some more time on this data. This is very interesting data. So for explaining our viewers in a little bit more detail. So let's talk about recent past, June 22. What you are saying is that when Nifty corrected over 3 months by 10%, Nifty 500 we are talking about here, the model delivered minus 13%, which is a 3% underperformance vis-a-vis the benchmark. Now, perfect. What you are saying that post 12 months from that period, where Nifty delivered 24%, the model delivered 31%. So there was a 7% outperformance. Similarly, you're talking about that whenever such large 2, 3, 4%. I mean, the recent example of December 20 is also very interesting, where the model underperformed by almost 9% in 3 months. The outperformance was even stronger to the extent of 17%.
17%.
So are you saying that whenever the underperformance is severe, the recovery is also going to
equally
be
sharp?
Equally sharp.
Yeah. So you will see, Deepak, again.
Would you suggest somebody to really either top it up or maybe take 3 to 6 months of time for staggering, or maybe add up on SIP? What is it?
So I think
somebody would doubt this, right? Somebody would say, boss, we believed in this idea, but actually it's not playing out. How would you convince them?
So I think, Deepak, see, that is the biggest advantage of any model-based portfolio or factor-based portfolio. You can actually backtest the data for as long as you want, and within that, any particular period which you want. Like what analysis we have done over here is all the periods of underperformance. So first, This is not abnormal. It has happened many times. So that is something we want to showcase. As you said, June 22, we are almost in similar situation. Nifty is down close to 10%. Benchmark is down close to 10%. Say 7-8%. We are down 10%. So just couple of percent here and there, but exactly same situation. And look at the recovery phase. And we are not saying that compulsory recovery has to happen. Look at March 19, June 19. If the fall continues, even there we are able to outperform. So it is not necessary that we only want a bull market or a rally in the market. It can happen that in subsequent falling market, because we are following momentum. And as I said, we are already shifting. So you will see in July and portfolio, we were heavily loaded on, you can say, your PSU names. We were heavily loaded on railway stocks. We were heavily loaded on some of the manufacturing names. And now we are already shifting towards quality because momentum is changing color. And that is why this strategy will always help you to outperform over a reasonable period of time, because we will change, we will adapt to the changing environment. And that is where a normal a value based fund which is following purely a value based strategy will underperform, continue to underperform. But now you will see our portfolio, like example is IT. In July we were 1% in IT, and as we speak today we are almost 8 to 9% in IT. So that clearly shows that our portfolio is making that shift from, you can say, purely a value or purely you can say manufacturing, defense, and railway stocks. We are moving into quality names like IT and pharma. So that 8 times rebalancing in a year, which helps us to, you can say, any stocks which are underperforming gets out of our portfolio, and any stocks which we have missed and is outperforming immediately gets added to our portfolio. So that frequency of, you can say, rebalancing almost 8 times in a year has always helped our strategy to adapt to the changing environment. And that's why you will see underperformance has always been less than 3 to 4%, but outperformance is always closer to double digit. So again, that December 20 was an aberration where you are seeing that 9%, but other than that, you will see underperformance is in the range of 3 to 5%, exactly where we are today. So that gives us more comfort that we are almost, you can say, closer to the worst period, and the recovery phase can start very soon. And for that recovery phase, it is not necessarily we want only a bull market. You will see if the fall continues like March 19 or June 19, even in a falling market, we can recover and we can outperform the benchmark over there also. So we are very much, you can say, confident, and we have tested this model enough, and we have seen live data also in some of our other funds like aggressive hybrid fund and balance advantage fund, where we see normally in a non-trending market, in a range bound market, our strategy tends to underperform. And as soon as the market becomes trending, whether it is a bullish trending market or a bearish trending market, our strategy catch up. So for all said and done, 2024 now has become a non-trending year because Nifty for the year is giving you single-digit return. So that is in line with, you can say, a performance in other funds, an existing fund. So one may say that this is backtested data. We may or may not trust this. But even if you look at the actual performance of aggressive hybrid fund, balance advantage fund, in all the range bound year like 2018, 2022, you will see similar kind of situation. And then in subsequent recovery phase, you will see we not only cover the underperformance, but again we go back to generate that 3 to 4%, 5% outperformance for the entire period. So not only for the period where we recover, even for the underperforming period, we cover up that also.
So, Bhavesh, it's quite interesting that you are not saying that markets are going to rebound, but you are saying that the strategy will adapt to the situation at hand, at play. And if markets continue to slide further, the relative performance is going to bounce back, is what you are trying to mention by highlighting the point of June 2019, where markets continued its downward rally, and the fall was limited to only -1% vis-a-vis the benchmark of -11. So what we are saying is that on a relative basis, this product bounces back very sharply because of the strategy that it follows. Excellent. Let's move on and talk about uh, a few of the things that you have seen in terms of portfolio changes, factor changes. If you could throw some light on where are these changes happening? I mean, we mentioned about uh, quality shift from, let's say, value to some other factor. You just mentioned technology in that context, 1% holding to almost close to double digit. And everyone seems to be talking about technology. What exactly has happened in the portfolio in last few months, and how has that really changed the nature of the portfolio itself?
Sure. So Bharat will be chipping in. Yeah.
Okay. Good afternoon, everyone, and thank you for this call. Deepak, yes, you rightly said about it. Uh, we have, if you look at it, the portfolio over last 3 months have also changed dramatically in terms of how
Bharat, if you could
the
switch
fact.
on your camera.
Okay.
Thank you.
Yes. So when I look at it, obviously, when we look at it, factors have changed over last 2, 3 months, and what we are seeing is. Uh, the portfolio has also changed, adapted to the new factor structures. What we have seen is quality and growth have come back, and what we see is uh, our position in the defensive have started increasing. When you say defensive, primarily what we mean is exposure towards more on the technology side, because these companies generate high ROE, these companies generate high cash flows. Consequently, our exposure to IT has increased. It was around 1%. Somewhere when we run the model in a paper format as at May month when we showed up during our road shows, it went to as high as 8% during July. It went as high as 11% in the month of September, kind of stuff. So you would have seen gradually the weightages in the IT sector has substantially increased. What we would have also seen is that in financial services we have started reducing weight, given that the value has not still emerged. So far till the month of October, we not see too much of value and momentum coinciding in banking and financial services. So weightage in banking and financial services continue to remain low to that extent. What we are also seeing is that capital goods still holds to that extent, but what we are seeing some amount of changes wherever we could do profit booking in terms of it, where we have sold something like ABB and added on to Cummins, where the growth continues to be strong. So growth plus momentum is still showing some of these stocks in the capital goods segment, and we are moving from some stocks to other stock. So those stock shifts are happening wherever we are seeing growth to that extent. We are also seeing some amount of exposure added on to oil and gas sector, especially something like BPCL, HPCL. Over last 3, 4 months, what we have seen momentum and value actually coinciding in this sector, primarily because of the fact the expectation was that given that was election period, there could be a chances that there could be changes on the petrol prices, diesel prices. There could be tinkering on that. That has not happened. Consequently, some of the momentum came up during post-election period, and consequently we saw momentum and value being in this segment, and consequently our exposure towards the oil and gas segment also started rising. So those are broad changes which has happened. What we are seeing going forward also, there is a continued trend where our exposure to defenses, especially on the healthcare, technology and consumers, will increase. This is what we have seen over last 3 months, and the trend continues in next few quarters. That's what we have seen historically. As soon as we pick up a sector, it takes another at least 12 to 18 months the sector continues. So we see the defensives are going to see a lot of weightages in coming quarters also, as we do our model churns during next this month and next month, kind of stuff. So those are changes which are there.
So there are two questions, Bharat, which has come up from our audience, and we will not like to make them wait. One is that please talk about uh, why factors change, why there is a change in factors' behavior, and why do we really see a shift from one factor to another? What is the logic behind this factor changes? Somebody want to ask.
Yeah, Deepak, it's a good question in terms of it. Why do factors change? Because if you look at it historically, also it's not always one single factor dominates in an environment. Depending upon macroeconomic scenario, different set of factors do well. In a period of volatility, typically defensive stocks do very well, and you would have seen actually in last 3, 4 months the defensives or the quality factors have done very well. Historically, also, when we looked at it in 2018-19, actually the defensive stocks have done well. Even if you go back historically, in 2014-15, after 14 rally 15-16, we saw actually defensive factors, especially quality growth, had actually done well. So during period of volatility, we have seen the quality growth factors doing well. In the period of recovery, we see actually value factors doing very well to that extent. So period of like 2021 to like 2024, beginning of 2023 and 24, you would have seen value as doing well. So there are different macro cycles which actually tells the factor movement to that extent. You would have actually seen some of these movement happening over last 10 years. For example, in 2013, when market was extremely in doldrum, where we had a lot of crisis with respect to geopolitical tensions in the Europe because of the debt crisis, or Indian political standards, where the political scenario was not so great. People shifted towards the defensive names or quality names like IT, pharma. At that time, that IT pharma did well. Even if you look at today as well, in 2024, the political scenario is bit weak, kind of that this is not a this is a coalition government. We are also getting a lot of news flows along with the market, which is keeping the people extremely nervous, and hence the shift for the stocks or sectors are happening toward defensive side. That's what we are seeing. That is the reason why we see factors movement across time. As macroeconomic scenario changes, factors do change out.
So factors in a way is only a reflection of changing investor behavior and their preferences at a certain point in time over a period of time, right?
Yes.
So let's since this is a relatively newer concept in the Indian context, globally factor investing, smart beta has been there for quite some time. Even at Edelweiss, we have been following, but from a general public perception perspective, it has been quite new. So can we go back and re-explain the entire process of portfolio construction? How do we really look at factors, large, mid, small sectors? So a simple rundown on the process.
Yeah. So just a second. So you will see normally the basic factor. What when you say what is factor, it is nothing but style of investment. Traditionally in India, it was only you can say growth versus value. These were the two popular style of investment. Then some of the you can say PMSs started talking about quality as a factor or quality as a style, and this style is nothing but in simple word factor for us. So we have you can say multiple ways of looking or selecting a stock. Some can be fundamental, some can be technical, and some can be on the basis of historical data. That is what we normally say quant based investing, or for that matter smart beta as an option. So what we do is we have a different way or different you can say attributes which tell us that why one should differentiate between stock A from stock B, and these attributes is nothing but factors. So the basic and the simplest factor will be size, where we say market cap is the criteria because of which you will decide whether a stock is going to give me higher return or you can say lower return. So historically, you will see multi-baggers will be more, you can say, will be easily
Only from the
available.
point of view of this portfolio, Bhavesh, if you could, in a summary, you could summarize that what exactly.
Sure. Sure, sure. So yeah, so when it comes to business cycle fund, again, what we did normally, people try to rotate sector using their fundamental view, that is top-down approach, where the fund manager will first take a macro call and then a sector call and then stock-specific call. What we thought is rather than you can say taking so many calls and so many assumptions and so many probability of going wrong, we will do a bottoms-up approach wherein we will first let the factor decide which stocks to buy, and then accordingly that will lead to sector, and finally that will be our business cycle call. So what we did over here is we select three you can say fundamental factors, which is growth, quality, and value, and we combined these three factors because standalone all three can have a prolonged period of underperformance, and that's why so we don't want to get into that 4 year, 5 year of underperformance, like value underperformed from 2014 to 2020, or like growth is underperforming from 2021 to 2024. So they can have underperforming period of more than 3 year, 4 year, 5 year. So in a, and in as we don't want to have such a prolonged period of underperformance, we decided that how to improve consistency of this fundamental factor, and that's why we club them with momentum. So now the strategy which we run is having three portfolios, or you can say three strategies. That is combination of growth plus momentum, quality plus momentum, and value plus momentum. So to just simplify, what is growth? So growth, like any other fundamental, you can say data. We look at quarterly result. We look at growth, and that growth is sales growth, EBITDA growth, EPS growth, PAT growth. We rank stock on the basis of all this number. So we look at quarterly result, and then after looking at their growth number, we rank the stocks, and then we decide that top 10 stocks will be our growth portfolio, or top 20 stocks will be our growth portfolio. But here, as I said, it is combination of growth plus momentum. So what we do, say for example, in large cap, we have to select growth plus momentum portfolio. So in large cap, first out of the 100 large cap stock, we will select 25 stocks which are giving us best growth. When I say best growth, this is average of sales growth, PAT growth, EBITDA growth. And this is that the stock which is giving you highest growth on the key parameter, that 25 stocks will be my growth portfolio. Now, within these 25 stocks, 10 stocks which has given me the best return on the basis of 3 month and 12-month momentum, that will be my growth plus momentum portfolio. So that is the first strategy. So momentum, we are looking at 3 month and 12-month return. Stock which has given us highest return on average. So we do average of 3 month return and 12-month return. Rank, we calculate rank of 3 month return, calculate rank of 12-month return, and then we take average, and the top 10 stocks on that average rank will be part of our portfolio. Similarly, for value, like traditional definition, we also look at price to earning, price to book, dividend yield. We rank stocks on all these parameters, and then again, out of 25 stocks on the basis of value, we select top 10 stocks which has given us best momentum on a 3 month and 12-month basis. And similarly for quality, again, we take the standard definition or the fundamental definition. We rank stocks on the basis of return on equity, return on capital employed, their volatility, and basis that again we rank them, and then out of that top 10 stocks on the basis of momentum will become part of our quality plus momentum portfolio. So here you will see, first, neither we are getting biased towards growth, quality, or value. All three have equal weightage. Similarly, neither we are biased towards large cap, mid cap, small cap. Large cap will be 50%, mid and small cap will be 50%. Our universe is top 300 stocks. 8 times in a year. So 60% of the portfolio get rebalanced in January series. So Jan, April, July, and October. And 40% of those portfolio get rebalanced in February series, which is after quarterly results. So February end, May end, August end, and November end. That is how 8 times in a year we actually revisit our portfolio and make necessary changes. Wherever momentum is fading, those stocks get out of the portfolio. And wherever we are seeing decent momentum, that stocks get added to the portfolio. So that is the simple strategy which we follow. We have done backtesting, as I said, for this strategy for almost last 13, 14 years. And we have already shared some of the data earlier, and some more data on underperforming quarters and all that stuff in this presentation.
So, Bhavesh, is it fair to say that momentum is the overriding factor with equal emphasis on value, quality, and growth?
Yes, yes, Deepak.
So,
So you
in,
can say
in
almost,
nutshell, it's a diversified portfolio
yeah,
with a large mid and small cap exposure, almost
yes,
50% large, 50% small mid, and evenly distributed in value, growth, and
quality.
quality. So fantastic. It seems to be, but you also mentioned that factors do change, and it takes sometimes uh, a quarter or two to really uh, get the trend right in terms of shift in trend. So is it fair to assume that in a from a month on month basis or a quarter on quarter basis, the dispersions could be higher, but from a 1 year, 2 year, 3 year perspective, that dispersion would actually turn into positive alpha?
Positive alpha. Yeah. So that is what we always endeavor to do, and that's why we say that uh, over any 3 year period, chances of underperforming benchmarks goes down drastically. If you would have seen our, you can say, NFO presentation, if you stay invested for 3 year and 5 year, 85% of the time on a rolling 3 year basis and 100% of the time on a rolling 5 year basis, we have outperformed the benchmark. So if you stay invested for that longer period, obviously probability of underperforming the benchmark, even by that 1 or 2% or 3%, what we are doing right now, goes away drastically.
So there are question, Bharat, Bhavesh, you may take any of you, that thematic funds, people have to time the market and be able to get their entry and exit right. So is it fair to us say that this particular product solves for it, or even here one has to be very careful about entry and exit? And
Uh,
if so, could you give some examples or maybe some data in the
Sure,
past?
sure. So, Deepak, as I said, when it comes to thematic fund, particularly sectoral fund, you have to be very careful about entry and exit because we have seen the best performing sector. If you take again the same period of analysis, what we have done for our fund, that is from 2011 till date, even if you have selected the best sector at the best point of time, the alpha you have generated over the benchmark is just 2%. So Nifty 500 over last 15 years would have given you 15% CAGR. The best sector, which is having the best time today, which is capital goods, have given you 17% return. So you're outperforming the sector, the benchmark by 2%. But if you end up selecting a wrong sector, even after 15 years, your return is just 7% CAGR compared to 15% of benchmark. So chances of underperforming is huge. You have underperformed by 8% and you have given a long period, 15 years, and even after that, underperformance has not gone. So that's why for sectoral fund, entry and exit is very important. For business cycle fund or a factor based fund like what we are doing, which is loaded on quality, growth, value along with momentum, timing is not important, but you have to stay invested for at least 3 year, 5 year, like any other equity product. 1 month, 3 months, 6 month return of any equity product can be random. It can have huge outperformance. It can have huge underperformance also. And that's why timing is not required over here. It is just you have to spend decent amount of time. You have to give at least 3 year, 5 year for any equity fund to show its true potential. But that is not true in case of sectoral fund. Even if you stay invested for 15 years, you may still end up underperforming the benchmark. And that is what we have seen in multiple sectors, whether it is telecom, whether it is media. There are various other large sectors also which are underperforming benchmark for last 15 years. Whereas in our strategy, as I said, if you stay invested for more than 5 years, till date, there is not even a single day of underperformance. So that clearly shows that timing is not important, but staying invested for 3 year, 5 year is actually required.
So, Bharat, the question is to you, and you partly answered this question, Bharat, about industrials. The question is that there is a profit booking happening in the industrials, and yet we have significant allocation to industrials as per the latest portfolio available to the person concerned. Could you please throw some light here?
Yes, so on industrials, yes, our exposure remains high. We have close to around 16.5% exposure to capital goods as segment. And when we look, generally, whenever the factors do change, we actually move from one stock to other wherever we are seeing growth opportunities coming in. If we look at it in last 1.5 years, where we look at growth metrics, industrial companies continue to post high set of growth numbers. If you look at it, the growth numbers for some of these industrial companies remain extremely high. What we have seen in last churn perspective, what we have moved out of companies like ABB, we have moved out to Cummins where the growth continues to be high. So you would see actually there has been internal churn within the capital goods sector. We have sold some of these companies where the growth has fallen, and consequently we have taken some profit booking in that set of names, and we have added on to some other names in the capital goods segment because growth continues to be high. What are we seeing going forward also is that the exposure to capital goods have started reducing, which we'll see. What we are seeing, the initial numbers, what we are seeing is that the momentum in capital good company have started falling off. So if the model remains true to its mandate, and that's what we are intended to do, you would see actually capital good segment actually reducing as the trend persist in terms of weaker momentum in some of the segments.
Thanks. So, Bharat, either you or Bhavesh, anyone can answer the next question. Why do we take these specific 3 month and 12-month period for deciding momentum? Are they too short, too long? People don't have a perspective. So, if you could share why we look at 3 and 12 month.
So, Deepak, we try to, you can say, factor in the latest change which happens in the quarterly result, and that is where we want to have a quarterly rebalancing, and that's why we take 3 month momentum. if you see NSE takes 6 month and 12-month momentum because they do rebalancing on a 6 month basis. What we think is 6 month can be a long period. 1 quarter of bad result and stock can have huge change in their behavior, and that's why we choose to have 3 month and 12 month. So that is, you can say it is, you can say neither. There is no perfect answer whether three is right or six is right. But as I said, different category of funds will have different strategy, and that is where we want to be, you can say, closely track quarterly results and change our portfolio accordingly. And that's why we have kept 3 months. But you will see most of the passive index of NSE has 6 months. So both
What
are
are the
doing
global
great.
standards for this, Bhavesh?
So there is no perfect, you can say, measurement. So if someone is in high frequency trading, they are looking at seconds per, you can say, seconds and minutes also, momentum of per seconds and momentum on the basis of minutes and hours also. Some, you can say, prop traders would be looking at weekly and monthly data also. And like we are into mutual fund and we want to have at least some stability and we cannot have a high churn portfolio, we prefer 3 months and 12 months. So there is no right or wrong answer. We have high frequency indicator where people starting from milliseconds and seconds and goes up to 200 DMA, which is almost 1 year.
Understood. But anywhere between a very short period to up to a year,
Yeah,
right? Depending upon what kind of investor you are, what horizon, if it's a 3 month trading opportunity that you're looking versus 5 7 year wealth creation, it's a different tool. So momentum can be used very differentiated way for the kind of approach that you take to investing, right?
perfect, perfect.
So one of the question, it's a more technical from an investing perspective, not for us, but the question is, the person wants to invest 1 crore, but the fund is not available for collateral. I think he or she means that NSE collateral or margin. What is the process for getting into that? If you are aware, please share. Otherwise, what we will do, we will get back to the person concerned and answer that question.
Sure. I think the criteria from exchange is 1,000 crore of AUM and some period of
2 quarters
history.
of, yeah.
History, yeah. So which I think we have just 3.5, 4 months old. So we will need at least couple of more months to fulfill that criteria.
So let me just, so there's a question, very interesting question, but I'm going to change it a little bit. By having 1/3 compulsory weightage to all three factors, wouldn't it lead to underperformance when either of these factors underperform significantly? The person has asked about value, but it's equally true for quality and growth.
Yes, yeah, it can always happen. The most important thing we want to solve over here is we don't want to time when it will be time for value or when it will be time for growth or when it will be time for quality, and that's why the overriding factor is momentum. So even within value, if you look at momentum as the factor, momentum will be the dominating factor. So 25 stocks with best value, and out of the 25 stocks, 10 stocks with best momentum will always be part of our portfolio. So momentum in a way will always help you to pick up the winners and avoid losers. And that is where, irrespective whether it is good time or bad time for any single factor, till the time you are having momentum as a navigating factor or the final determinant, you will keep on having that less period of underperformance and higher period of outperformance.
So this is a very interesting question, and I'll rephrase the question. The question is that how much of the portfolio is managed passively by looking at the model and how much is active. So I think the question rightly is that is there a manual intervention apart from what model is telling you
So
in the model?
apart from so Deepak, apart from risk management, there is no manual intervention. So two phase of risk management. First is at the time of you can say filtering our universe. So as I said in the beginning, our universe is top 300 market cap company. So our risk team will be doing individual due diligence of all the three companies. They will be looking at parameters like corporate governance, management, previous track record, liquidity, debt to equity, promoter pledging. Basis that they will, you can say, in a way eliminate maybe 15 to 20 stocks which will be not part of any of our portfolio. So not only business cycle fund but any of our actively managed funds also. So that will be the first level of manual intervention. So once that clean universe of 270 to 80 stocks comes to us, after that it is purely process driven. The second level of intervention, again from risk management point of view, is Say, for example, out of the 280 stocks which are part of our universe, some stocks become part of our portfolio. 55 to 60 stocks will be part of our portfolio. And then within that 55 to 60 stocks, if there is some negative announcement, which is like some, you can say, corporate governance issue comes up, or promoter change their line of business, or any other, you can say, situation, change in regulation, or government, you can say something from government point of view, that point of time, again, purely from risk management point of view, we will exit that stock from our portfolio. So other than that, it is purely model driven and process driven, with almost, you can say, negligible, nil, you can say, intervention from our end.
So it'll be very important for people to understand why we don't intervene. Because if you intervene, then the back testing becomes irrelevant, correct?
Yeah. Yeah.
Because you can't go back in time and intervene.
Yes.
You have to be true to the model, and then only backtesting data gives you the correct picture. Now, the second question, and one more interesting question, is on market cap, distribution. The product typically has 50% large and 50% mid and small. The question is that if mid and small are expensive, why can't you go overweight on the large cap?
So again,
and if you could also take the opportunity to explain how much of small cap actually we own at any point in time.
Sure. So as I said, Deepak, we don't want to guess whether large cap will do good or mid cap will do good. Like, the main purpose we want to solve is we want to remove our biasness. So that is something which is started from sector selection to factor selection, and now to, you can say, market cap selection also. Here, for technically, we are purely into large and mid cap because universe is top 300. Now it is just the technical definition which says that 251 to 300 is small cap. But if you will see our breakup, almost 50% will be in top 100 stock, 40%, close to 40% will be into 101 to 200 stock, and only 10% will be in 201 to 300
90% stock. In top 200, basically.
Yes, yeah. So in 95% in large and mid cap. So it will be only that 4-5%.
Very, very limited portion in small cap. That's what. Also, I mean, this is very interesting, and I'm drawing inference from this question. Can you construct a portfolio which is 100% large cap and build it on momentum and deliver significant alpha? 5% alpha, 6% alpha.
So you will see there are already passive products where you have products on 150 stocks. So alpha low vol will be you can say quasi momentum plus low vol portfolio, which is
I'm only talking about pure large caps in the construct that it is.
Yeah, so we can run portfolios on any. So we have factors, we have backtested data, we have historical. You can say all kind of strategies available with us. We just have to tweak weightage of our strategy, and we can run as and when what kind of portfolio we want. So you will.
Do you run any strategy on that currently?
So Edelweiss large cap fund. So it is 80% large cap and 20% others. So like normal large cap fund, which is again purely on factors. But the factor over there is growth and quality, and we are not looking at momentum. But I think business cycle fund 50% is momentum, but again it is not pure large cap. Aggressive hybrid fund again is dominated by momentum, but again not pure momentum. So on active strategy, the closest will be. I will say balance advantage fund, where our asset allocation is purely momentum based, where we are using momentum as a factor to increase or reduce our equity. So there are different strategies within our, you can say, active plus passive funds, but 100% large cap, no actively or passively managed fund, which is purely large cap. But bits and pieces, we are doing large cap asset allocation, we are doing sector rotation, we are doing stock selection of large cap fund using combination of different factors, but it can be done.
Thank you so much. Thank you, Bharat. Thank you, Bhavesh. It was quite an enlightening session, at least for me, and I'm sure for our partners. What I would appeal to you and request that since it's an evolving sector and people are still in the formative stage of their understanding about how factor investing works, and it will be a combination of understanding and experience of putting people's money, their own money, and seeing how it really works. So can we make this a quarterly feature where we come talk about what has happened and take some questions? Maybe those questions will be repetitive in nature, which we would have already answered in previous calls. But I think it's required at least for a year and a half for people to get better understanding, deeper understanding of this segment, this entire
Sure,
process of
sure,
investing.
sure, Deepak. We are more than happy to release as much data as anyone wants from our end, and we can have this periodic call also, both in good times as well as bad times. We are there to, you can say, explain as many things as we can, and more than happy to do that as and when everyone is comfortable.
So thank you so much. I think I'll ask the marketing team to put up a quarterly calendar on and for an update on this product, as well as if there are any partners, any investor who would like us to share more details, we are happy to do so. Please reach out to us directly or to through your relationship managers. Our team here is very much keen to solve your queries. Once again, thank you so much for taking out time and asking all your questions. They were very, very insightful questions, and we hope that we have been able to answer that. So, thank you so much. With this, we come to a conclusion of this call. Thank you.
Thanks,
Thank
everyone.
you.
Thank you.